Hi, and welcome to this introduction to the Australian economy. Australia comprises 6 states and 2 territories. The capital city is Canberra, and the population is estimated at around 23 million. The population of Australia tends to be concentrated primarily along the coastal regions of the country and in the major cities. Australia is the 12th largest economy in the world as ranked by GDP or gross domestic product. As we saw in our earlier discussion, the US is the largest economy in the world and China is number 2. Per capita GDP, which is a rough measure of average income, can be measured in different ways, but generally Australia is ranked around about number 10 in the global list. This contrasts with the US, which is around about 6 or 7, and China, which is generally around about number 90. Australia's ranking would place it above Germany, above the UK, and above Japan. Australia's been experiencing a long period of steady growth, characterised by relatively low unemployment compared to the rest of the world, and relatively low inflation, as captured by the CPI, or the Consumer Price Index. While export growth has been strong in Australia, the figures in the table highlight some of the key underlying influences that buffer the Australian economy. For example, a fall in export growth in 2011 is a measure of the impact of weather, things like floods and cyclones, and also falling commodity prices and the high Australian dollar. The surge in imports, which is seen in 2012, was driven in large part also by the high dollar, which makes imports much cheaper, as well as by imports related to mining investment activity. Unemployment in Australia, although relatively low, is just starting to edge upwards. This is a signal that the so-called resources boom, or rather the investment phase associated with the mining activity, is starting to ease, and also an indication of the need for readjustment in the Australian economy. Looking at Australia's long-term growth performance, we can note several things. Certainly there's been 22 years of positive growth since the last recession, quite a remarkable feat by global standards, but also we observe in recent times much less volatility. This is in part due to a shift in the 1980s to a flexible exchange rate regime, more independence for the Reserve Bank in terms of its conduct of monetary policy, and more flexible labour markets. As we will see in more detail, the economy is also much more closely linked with East Asia, particularly China. China is Australia's number 1 trading partner, and Asia generally takes more than 60% of Australia's exports. A significant part of Australia's GDP growth story over the last 2 decades can be put down to the so-called resources boom. This can be looked at in several phases. During the mid-2000s, we saw a period of high prices which boosted Australia's terms of trade. Commodity prices rose sharply, and despite the drop in 2009, the global financial crisis, they've picked up again. This surge in prices led to phase 2, which was a big boost to investment by producers, particularly in iron ore, natural gas and coal areas. This was an endeavour to boost capacity, and we saw investment as a percentage of GDP rise to about 8% from an historical average of around about 2% in the resource investment area. This has led to the third phase, where investment is starting to ease off and we're moving into a production and export phase for the resources industry. It's interesting to note, looking at the long-term growth, the dip in 2009 associated with the global financial crisis and the pickup in activity subsequently. As mentioned earlier, this can be ascribed in significant part to the boost given by the Chinese. There was an easing of credit in China, a boost to infrastructure spending, and this was reflected in rising commodity prices and another pickup in exports for the resources sector in Australia. If we look at the structure of the Australian economy in terms of the industry share of output, we see that mining is around about 12% of output. But in fact, it contributes only around about 2.3% of employment. It's very capital intensive. Like most developed countries, it's the services sector which is the largest employer in Australia and contributes the biggest share to output, it's just under 50%. And in Australia also, the services sector is becoming an increasingly important export sector. When we're talking services, and we'll be discussing this in much more detail as we go through, we're talking such areas as education, tourism, financial and insurance services, design and engineering, general business and consulting services, health, government. Okay, so it's a very wide and varied sector and presents a lot of opportunities for Australian business. If we look at manufacturing, it contributes around about 8% of output in Australia and a similar share of employment. We can identify a few key factors which will be important for the Australian economy. Japan certainly is emerging from its malaise, and there are strong prospects there. The US is recovering, but there is some uncertainty still. The liquidity is the big story there, and this will have implications for exchange rates in Australia. And exchange rates are very important in terms of Australia's competitiveness in global markets. Asian growth generally is slowing, but as noted earlier, if we look at China, a slower growth rate there is associated with a much larger economy than was seen in the past. Moreover, the emerging economies generally, particularly in Asia, will be driving world growth for the foreseeable future. These developments will have important implications for Australia, given, as I mentioned, the slowdown in business investment phase of the resources boom. What we will see is increasing volumes, ships, increased production in the resources area. There does need to be a boost in demand domestically from other sources and from other sectors other than mining. This is likely to be the non-resources business investment sector, perhaps consumption, dwelling investment, or other export areas, including services. This will be dependent on developments overseas and also in internal economic management. The impact of the exchange rate will be important in all of this. There will be an interplay of exchange rates, monetary policy, fiscal policy, and labour markets, developments and productivity. The prospect of a weaker Australian dollar is important for the Australian economy. If we look at the long-term Australian trade performance, we notice a couple of things. One is the very cyclical nature of both exports and imports, and also the impact of the high Australian dollar over the last decade or so in terms of the impact on imports particularly, but also in tempering exports. If we look at exports in a little bit more detail, we can identify a couple of features. We see that resources has been growing steadily in terms of export volumes. The slight dip in 2009 at the time of the global financial crisis was followed by a spike and a recovery. Services again showed steady growth, but also there was a downturn after the global financial crisis. Several issues came into play there. One is the high Australian dollar, also some changes in visa arrangements by the Australian government, and increased competition, particularly in education markets from overseas suppliers. There's a lot of cyclical behaviour in the rural export figures. And if we look at iron ore and coal in particular, again we see that marked spike after the global financial crisis, again a response to the stimulus that was coming from China. If we look at Australian services trade, both exports and imports, we notice that there's been a sharp spike in activity following 2009. Looking at Australian services trade, we see that there's been a steady upward trend, steady growth in both exports and imports. And in fact, the export performance has been outstripping imports in recent years. If we look at Australia's trade in goods and services in 2012, these figures come from a Department of Foreign Affairs and Trade publication, and the link for this is available on the next slide, so you can spend some time looking at this in detail yourselves. Just to get some sort of idea of what's been happening, if we look at Australia's top 10 partners in 2012, we see that China is number one, both in terms of goods and services. Japan is the second largest trading partner, followed by Korea and the United States. If we look at imports, again, China is ranked number one for goods, and certainly with services is up there. The United States figures quite prominently in terms of a source of imports of services. Again, this is an indication of areas such as financial services, telecommunications, insurance, and the like. Here we're looking at Australia's top 25 exports of both goods and services in 2012. And perhaps this is quite instructive. We see, perhaps not surprisingly, that iron ore and concentrates is the largest export item, followed by coal and gold. But surprisingly, perhaps, we see education at number 4. Similarly, at number 6, we have personal travel services, excluding education, which captures primarily tourism. And again, number 12, we have business travel services. So the service sector features very strongly in the top echelon of Australia's exports. Education certainly is above traditional items like wheat, beef, and also copper. The URL dfat.gov.au allows you to explore this in more detail at your leisure. This map provides a picture of the key mining areas in Australia. The primary mining areas are in Western Australia and also in Queensland, but as you can see, there is mining activity in many different parts of the country. These charts provide a slightly different perspective on Australia's export performance in 2012. What we pick up here is clearly that primary products dominate exports as a share of total, but that services at 17% are very significant. If we look at imports, we see that manufacturing dominates and services also quite strong at 20%. So quite a different mix, reflecting Australia's comparative advantage in different areas. If we look at Australians' merchandise exports by geographic regions in 2012, as mentioned earlier, we see China is far and away our largest trading partner. 29% of exports go to China. Japan, Europe features relatively low down the scale. The United States even lower. If we look at the chart on the right, we see that Australia's exports to China have grown very strongly over the last 2 decades. Similarly, our exports to Japan have held up quite well as well. Korea, another East Asian trading partner, features prominently. So if we look at exports by destination, by share of total, we see that, again, China features prominently, followed by Japan, the EU, South Korea. The startling picture that we see, again, is how China has risen so strongly over the last decade or so to achieve this place of prominence in Australia's trading partnership. If we look at imports, again, we see a similar story. China is far and away the largest source of imports. And if you look at the trend over time, we see how China has steadily grown in importance in this relationship. If we look at East Asia overall, it's over 50% of Australia's imports. As mentioned earlier, Australia came through the global financial crisis in large part due to the boost in commodity prices, which resulted from China's fiscal stimulus. China eased off on their credit, which saw a boost in infrastructure spending, and this was reflected in the commodity prices. An important factor for Australia is going to be what happens to commodity prices over the medium to longer term. If we look at prices as they are at the moment, they're below the peak of a few years ago. But if we take a very much longer term view and look over the last 40 or 50 years, we see that prices are not that high in a relative sense. What's happening now in places like China and also in India is growth being driven by massive infrastructure spending. In China, as we saw, massive urbanisation and the investment that accompanies that. If we look back in recent history, the 1980s, the 1990s, global demand was driven more by IT, the tech boom, and the financial sector. This is more like what we saw in the 1950s and the 1960s, and the commodity prices should reflect that. Looking at some other important prices for the Australian economy, we see that rural prices are buoyant again after a downturn, and similarly oil prices are back from their low at the GFC. So going forward in Australia, we have a situation which is not dissimilar to that in China. Australia also needs to restructure and rebalance its economy, not to the same degree and on the same scale as in China, but following on from the business investment boom, there's a need to consider the domestic demand situation in Australia and how finely balanced that is. We can expect the resources sector to continue a strong export performance over the medium term, but if we want to maintain employment, if we want to stimulate and maintain strong growth in the economy, then further drivers of demand need to be found. We'll be exploring some of these issues in terms of the relationship between Australia and China in subsequent weeks. There does seem to be opportunity for other export sectors, other areas of the economy to take up the slack.